Hello and welcome to tonight's session on trading psychology. We have a large number of people here tonight, so I went ahead and just sent out a broadcast message. If you do have questions, please type them into the question function there on your panel, and I'll check back periodically and hopefully be able to answer those as long as they are on topic. My name is Brian, and I'll be speaking to you about trading in the economy, and trading psychology will be the main topic tonight. Trading in the new economy, that is. And you can see that I titled that, overall title is Back to Basics, and I think that's very, very important. We're seeing a lot of breakdowns in relationships right now that used to be in place that aren't in place right now, one of those being gold and how it's tied to equity prices and fear. Another of those might be the U.S. dollar and how it's trading when the equities move in certain directions. A lot of these different relationships are breaking down. They're breaking down to different news events. That's something we'll talk about as we get into trading psychology tonight. So you have my email if you have any questions there, and then you also have my blog address down at the bottom there where I try and do daily updates. I definitely updated on the market commentary today just prior to the FOMC announcement. It was busy enough that I probably should have updated it again, but you guys get my take on it this evening. So just a brief disclaimer. Let's get this out of the way. All right, so the outline for this evening, we're going to talk about fundamental analysis. We'll briefly touch on technical analysis. I don't want to focus on it too much because I want to go right into trading psychology. This is focusing on you and your trading plan, your game plan, and then I want to touch on the topics of trade risk and account risk. So let's just talk about fundamental analysis. I'll leave this slide up here so that you can see different ways of staying on top of it, and I can run through those. ForexFactory.com, you can get there right through the Education and Online Tools tab in Interbank FX. You can always time that with CNBC. CNBC will talk about any of those events that are on that calendar. They'll be talking about that. So you don't have to sit there and hit refresh on your computer. You can just have CNBC running in the background. I say CNBC on the background for breaking news stories, things like that. You have to be careful. There's a lot of news out there. There's a lot of junk out there. You obviously want to be tuned into the really market moving news as far as the overall markets go for the most part. And then you have Bloomberg TV and Bloomberg.com for good stories. You have your broker providing you good fundamental analysis, and then obviously there's many, many great sites out there that you can peruse the internet for on fundamental news. So what's going on today? What was the highlight of today? Well, it was obviously Ben Bernanke and the Federal Reserve came out. They didn't change anything as far as the statement, as far as the interest rates go. They're going to be low for another 2 years. They said through mid-2013 they'll be exceedingly low. But what they did do is kind of introduce us to the quantitative easing 3, if you will. Quantitative easing is going on in Europe as we speak, so why not add a little bit more to it in America? But the whole point is we're getting quantitative easing because the fundamentals are pretty bad out there. I talked about that on my blog today. Does the Fed have information ahead of us? Who knows? Are they privy to unemployment data, things like that? Who knows? But they told us that things are moving along slower than what they'd like. They're saying employment data and labor data is moving along slower. They're saying growth is happening slower, and as a result, they're not seeing price pressures or inflation, so inflation is not a worry. So when you have CPI, Consumer Price Index, and PPI, Producer Price Index, you don't have to worry about those because we're not worried about inflation. There is quote unquote no inflation out there. So that's what's fun about paying attention to these big overriding themes. They're telling us, the Federal Reserve is telling us what's important to pay attention to. Pay attention to growth in retail sales and consumer confidence and things like that. Pay attention to initial claims coming out tomorrow. Every Thursday we get those. Pay attention to the monthly employment report, the employment components of Chicago purchasing managers and the national survey of purchasing managers and the national survey of the manufacturing sector and the services sector. Pay attention to those employment components. That's what they're telling us. So the right now, the fundamental landscape is constantly changing, and that's what I've been writing about in my blogs the past few days. You've got to be really, really careful with your trading size. You've got to be very careful with your emotions. You've got to be careful with your opinions, because things can change in a heartbeat. Someone can speak around the world. Something can be changed as far as interest rate policies and things like that, and dollar valuations and things like that around the world. So you cannot get married to anything. You have to be open and understand that things can change in a hurry, and so that might affect your trading plan. Technical analysis. What are the traders doing with the fundamental news? Again, we're not going to get too much into this tonight. We may look at a few examples as we get into our trading psychology examples and things like that. But overall, we always have to say, what is driving us, and then what are the markets doing with it, and then we use the technical analysis and the charts to say, this is where I believe is a good valuation, it's oversold or it's overbought, and I'm going to get in here with a trading plan, and I have a risk reward because there's no guarantees out there. So the technical analysis and the charts just help us with the timing and the location of everything. I talked right off the bat about those intermarket relationships, gold prices and equity prices, the U.S. dollar and equity prices. Again, sometimes they're in play, sometimes they're not. We as traders have to identify, hey, it's not working, it's not in play, and back off from it. Oh, it is in play. I'm going to take advantage of it right now. So every day it's very, very different out there. All right, moving into the main theme of tonight, trading psychology, defining you as a trader. Every single person I talk to on the phone on a client relationship, every person listening in this evening, you guys are all in different places in life. You have different risk tolerances, different account sizes. Some of you have jobs. Some of you are retired. Some of you have part-time jobs. So your time available to trade is different. Your trading style is therefore going to be different. Someone who works all day cannot be an intraday day trader. They're probably going to get fired, and someone else will be in there to do their job very, very quickly. Someone who's retired and doesn't want to sit in front of the markets all day has the ability to be a day trader, but they don't have to be a day trader if they don't want to be. Other things that affect trading style might be your overall risk tolerance and things like that. Maybe you don't want to be pressing the button all the time. Maybe you want to be waiting for a couple days, a couple weeks, a couple months for trades to set up. So risk tolerance has a lot to do with it. And then overall goals have a lot to do with it. Are you trying to grow your account? Are you trying to grow the account and also hedge your overall equity portfolio and investments? So you guys know that I always show you foreign currency charts. I always show you equity and option charts, because a lot of the people I deal with have money invested in the markets, and they're looking to create income off of that. Those investments, they're looking to protect those investments with option strategies. They're looking to protect those investments with intermarket relationships, looking at foreign currency to see if that can provide them an edge to take advantage of a leveraged market and protect their account. So it all depends on what you're trying to do as a trader, what you're trying to do as an investor. So these are all personal, and like I said, every single person listening in tonight, you have to define these first, and then you can start to arrive at who you are. There's about 4 different trading styles in equities and options. Day is 1, swing is 2, then you have intermediate is 3, and then you have position or investor would be 4. Sometimes I like to combine them. I like to combine the first 2. Day can also be scalper, where scalper is very, very short-term intraday. So sometimes I like to combine those into swalper, S-W-A-L-P-E-R. Maybe that's my term, I don't know, but it's kind of a scalp swing or a swing scalp mix, which can be a lot of fun. I think foreign currencies have a lot of those swapping opportunities. So that's for equities and options, those 4 trading timeframes. For foreign currencies, it changes a little bit. I don't really think with the 24-hour data going on and the news coming out and affecting, your currency pair, I don't really know if there's a middle ground. I think you're an intraday trader, and then I think you're more of a longer-term trader, and longer-term might not be months like it is for equities and options. It could be days for foreign currency. So I kind of look at some of my traders are going to be intraday traders, where they open and close positions within a few seconds to a few minutes, maybe a half hour at most. And then we also have kind of the people that are doing the hedging, and they're looking at 3, 4, 5 days of data, maybe a week or 2 weeks of data, and then they're putting on a larger trade that might last 2, 3 days on either side, 2, 3 days to get out for a loss, or 2, 3 days, 4 days to get out for a profit, maybe. So I don't really think that there's the swing and the intermediate trader in foreign currency. I just think there's too much volatility, and also I attribute that to the leveraged product. Is you're dealing with a highly leveraged product, much more than options and, of course, equities, because they're not leveraged at all. But just the size of the moves are just too big, and if you're caught in the middle, if you have an account size kind of on the smaller side, I just don't think you have the opportunity to wait a half hour, 2 hours, 3 hours, carry a trade day after day after day, because there's just too many news announcements affecting one foreign currency pair and the other. So you're basically dealing with two economies, and if you're only trying to risk 30 to 50 to 60 to 80 pips, I don't think you can get away with that just leaving it on overnight, going to bed, and hoping it works out. So the smaller trading size that you have, you're dealing with intraday trading. The larger it is, then you can open that up to kind of hedging your investments, because that probably means that you have larger equity investments, things like that, or you can leave it open to more multi-day trading, and we'll look at some examples of that in just a moment. Talking about account risk, there's two terms we're going to go through tonight: account risk and trade risk. Account risk is number one, and this is kind of it's stamped on your forehead. It's your constant. 1 to 3% of your account size is what you should be risking. 1% is obviously on the conservative side. 2-3% gets a little bit more aggressive. I don't really want you going outside of that 3% unless you're starting to hedge, and maybe you're using your trading account as hedge of a much larger, and you say my $80,000 account is part of my $1.5 million portfolio that I'm hedging. Then, as you see the bullet point there, it could be larger. That risk size could be larger if you're hedging a larger portfolio. But if you say, this is my last $5,000 and I'm going to put it into the markets, and that's your choice, knowing that they're risky, knowing that if you go in undisciplined, that can be very, very dangerous, then obviously you want to risk a very, very small amount until you get to be very, very confident, to be very consistent and accurate with your trading decisions. And again, as far as that hedging goes there, you can see in the parentheses, if the relationships between foreign currency and equity markets are working, we may put that on. In the past, the relationships between the Australian dollar and the gold trade were 1-to-1. Now, the Australian dollar is doing its own thing and gold is doing its own thing, so those relationships aren't there. They come and they go. That's why I think that a lot of my clients who are understanding the overall markets as far as how they're interrelated, and some are learning options and foreign currency side by side, it helps them because they're starting to see these relationships and starting to see these opportunities come about. So the overall point is traders risk a very, very small amount of their account. We're talking about 1%, 2% of our overall account size. That's it. So let's throw out some numbers. Let's say that some of you out there have a $4,000 account. Go ahead and do it on your calculator. 4,000 times 2% is $80. If you can stomach $80 being lost in a heartbeat, even the best laid trading plans can have something go awry. Someone, spoke overseas. A package was left by someone by mistake in Grand Central Station, and people got up in arms, and it hits the news wires. Even the best laid trading plans can go wrong. That's why we put stops on. That's why we risk very, very small amounts. So if you have a $4,000 account, stamped on your forehead is $80. 2%, $80. That's all you can lose on any one trade. Now remember, we're going to try and make something with that risk. So if we risk 80, we might try and make $100. Or if we risk 80, we might try and make 120 or 140 or 160 or 200, whatever your risk reward is. If you risk 1 and want to make 2, risk 80 to make 160. Risk 1 to make 3, risk 80 to make $240. Let's go to a different size account. Let's go to a $100,000 account. All right, same thing, 2%. This person is looking at $2,000 that they can risk, and they can risk $2,000 to make $2,500, to make $3,000, to make $4,000, to make $5,000. So you can see it takes a lot of money. It takes a large account size to, if you're trading with the right account risk, to grow your account to something. So if you have a job and you want to say, I'm done with my job, I want to replace that $4,000 a month or $6,000 a month income, and you have a $40,000 account, that might be stretching it a little bit because you're probably not going to be able to do that risking $80 to make $100 or $200 unless you're trading very, very frequently and you're right all the time. Traders don't have to be right all the time. We don't want to be right all the time. That's why we use risk reward. I risk 1 to make 2, risk 1 to make 3. Therefore, if I have good trading management and I get into good locations and I have more winners than losers and my winners are bigger than my losers, I can make money 50 to 60 to 70% of the time and I can be okay. So again, you have to find out how successful you are as a trader, how big your winners are to losers, and you'll start to find out what's available to you in your portfolio and what you're able to make and what you're able to supplant your income with. The other thing that I say, and this is the biggest thing, the markets drive us. If the markets aren't volatile, we can't trade. We can't make a mountain out of a molehill. If the markets are volatile and we understand them, great. If they're super volatile and there's speakers going on every day and they're moving it and we can't understand the movement and the equity markets are gapping up 100 points today and gapping down 100 points tomorrow and up 100 points the next day and there's so much movement and so many people speaking that we can't read it, then we have to also back off. So again, every single day we learn something new. Every single day we have to do a gut check and say, am I getting this? What's going on? You know, how much do I want to risk? How much do I want to, risk of my account? How do I want to manage my winners, losers, things like that? So account risk, the bottom line is it's small, consistent results over and over and over. Trading is definitely not a get-rich-quick scheme. You can see here most traders, industry standard, risk between 1 to 3% of their account size on any one trade. So that's your account risk. Your trade risk, it depends on your time available to trade. This defines your trading time frame. So let's go back to that person with the $4,000 account. There, we found out that basically 2% of that $4,000 is $80. That's it. All they're allowed to do is lose $80. Let's just stick in a mini account just to keep it easy. In a mini account, basically every pip is worth, when it's paired with US dollar, I'm just going to round it to $1. So this person, if they wanted to get into a trade and they did one contract, they know that they could lose 80 pips because 80 pips equals basically $80. So they could do one contract if they wanted to have an 80 pip stop loss. I think that's a little bit big for a smaller account size and a shorter term time frame, because I don't want to risk 80 pips and have to try and make 100, 120, 140, because that might be a pretty big trading range for that day. So most intraday traders are trying to make 10, 20, 30, 40 pips basically on a trade, depending on the trading time frame and also depending on the volatility of the day. For the most part, 20 pips is a pretty big move, depending on the average ranges and things like that. So, if you risk 10 pips or 15 pips to make 20 to 30 pips, that's pretty good. So this person says, I can lose $80. Every pip to me is $1. In this specific trade, I'm going to risk 20 pips to make 30 pips. Great. 20 pips has now become their trade risk. How many pips they're going to risk on this specific trade? Your trade risk gets divided into your account risk. So 20 pips, which basically is $20, gets divided into your account risk of 80, and that comes out to be 4. This person could do 4 contracts. If they lose on 4 contracts and lose their 20 pips that they said they were able to lose on this trade setup, they're going to lose about $80 with, give or take commissions. I don't really factor in commissions. They're a part of trading and a part of life as far as the trader goes, so I don't really worry about it. I just know that around $80 I'm going to be out of my trade. And if it goes 30 pips my way, 25 pips my way, 35 pips my way, whatever it is, I multiply that times 4, and that's going to be my gain. So that's how I set up my account risk. It's drilled into my head on a $4,000 account. 2%, it's $80. Now every trade is a little bit different. This trade I might risk 15 pips. This trade I might risk 11 pips. This trade I might risk 17 pips. This trade I might risk 20 pips. I'm not, as an intraday trader, really interested in risking more than 20 pips probably, because 30 pips, 40 pips, 50 pips, if I'm risking 40 or 50 pips, I'm trying to make at least 40 or 50, and me personally, I feel like that's a lot in a trading day. That's not a lot in a very active trading day like today, when we had a big announcement and a big change in sentiment, basically. But for the most part, I like to think that average trading ranges in the pound are about 150 pips, euro about 150 pips. Aussie closer to 100, New Zealand closer to 100, US Canadian closer to about maybe 80 to 100, US Swissy 80 to 100. Sometimes they're bigger here and there, but I don't want to ask for 50 or 60 pips if it's only moving 80 to 100 pips the whole day. I'm asking for, in a small amount of time, in my trading time frame, I'm asking for a lot of pips based on how much it moved that day. So the less pips that I can risk, the less pips I need to make the trade worth it, the more likely I'm going to go and get into the trade. I'm going to do an example of a long-term trade right now. So let's just expand this out instead of our 15-minute chart, and we can look at the pound. Okay, so you can see this is when Bernanke spoke in the Federal Reserve today and what happened as equities took a big dive down, U.S. dollar strengthened. I think it had to do with a couple of things. The equity relationship that was in place. When the equities get really hit really hard, then you see a flight to quality in U.S. dollar, but it also had to do with the announcement today and the different maturities and things like that that the Federal Reserve will be buying. So that helped to strengthen the dollar. Let's just look at a larger time frame, basically. So let's just say that we have the pound getting weaker and weaker and weaker. Day after day, we went from 1.66 all the way down to 1.55, basically. So lost 11 pennies, 1,100 pips. Maybe someone says this old resistance back here, or this old support back here is going to hold. I'm interested in buying it down here and having it bounce off and go up. So they might say, it's come down 1,100 pips. I think if it bounces off this old support level here, it can go up 400, 500, 600 pips like it did in the past. So this person might be willing to risk 200 or 300 pips to make 500 or 600 pips over 2, 3, 4 trading days. That's very, very fair. But you can't do that with a $4,000 account. You can't do that with a $10,000 account. $10,000 times 2% is 200 pips. So basically, you could get away with one contract, risk 200 pips, and if it goes your way, you make 300, 400, 500 pips. Maybe a $10,000 account, you can do that. $50,000, $100,000 account. Now you can start to see you can put on, your standard lots and things like that, and be able to do it. But so basically, if you're between 0 and 10,000, you're kind of on that shorter term time frame. And again, I don't like to say that there's a middle time frame like in equities and options that aren't leveraged as much. I don't like to say there's a swing in intermediate because I don't think that you can risk 20 or 30 or 40 pips or maybe 50 or 60 or 70 pips, leave the trade open and go to sleep, wake up the next morning and hope everything is okay because there's too much news. By the time you go to sleep in the United States, Asia's already open and getting ready to go for their day, and then Europe is going to go for their day. And as you know from our foreign currency calendar, there are things happening all day and all night. So Tuesday morning, basically, Thursday morning. So this is Eastern time. So we already, since we finished trading in the United States this afternoon, this happened basically right near the close, 2:23 or so. We closed at 4 o'clock Eastern. We already had stuff happen in Australia, in New Zealand. We're about to have stuff happen over here as far as flash manufacturing. And then the euro is going to pick up. So basically you have Asia going while you're sleeping or finishing up the work day basically. You have Europe ready to go, the euro region. So I think you leave a lot to chance if you're risking 50, 60, 70, 80 pips and hoping that the next day it's going to be okay. I just think there's too many announcements that can move it. So that's why I say I think you are an intraday trader, and I think that you're kind of the bigger multi-day trader, but you have to have the account size to reflect that multi-day outlook. So again, if anybody has any questions on what I'm talking about, please go ahead and enter them into that questions tab, and I'll try and answer them. So as we kind of wrap up a little bit on the trading psychology, you can start to see that trading time frames are pretty big, and you have to be honest to yourself and say, what can I achieve? If you have a full-time job, I have a hard time believing that your boss is going to be happy if he sees you staring at these charts all day. If you have a smaller account, I have a hard time believing that you can hold on to your trades day after day after day, hoping that everything works out and that all of the news going on around the world won't affect your trade or your support or resistance. And that's one thing that I wrote in my blog today is by the time the pound gets down here, and for whatever reason it's weakening against the U.S. dollar, equity relationship, whatever it is, by the time it gets down here, just because support is there doesn't mean support will work in the future. We like to say past performance is indicative of future results, but there's no guarantees. That's why we have some risk for some reward. We have a trading plan. How many pips do we want to risk for our account size? That kind of stuff. So there's no guarantees out there. So by the time it gets down here, I'm not so sure I want to buy it. I don't know what's going to get me excited down here. Do I think it's cheap? It's cheaper. That doesn't mean it's cheap. It can get a lot cheaper. It's cheaper than obviously up here, the pound. So the pound is a lot cheaper, 11 pennies cheaper. But that doesn't mean that just because it's cheaper and just because it's hitting an old support, I want to buy it. I might have to go out to a longer term chart and say, you know what? This support level here and this maybe support level here and this support level here, it's not big enough in the new light of things. Whatever Bernanke said, whatever they're doing over in Europe, that might cause the pound or the euro to weaken more significantly. And you know what? I have to wait a little bit more, whether it's a moving average, whether it's a Fibonacci, whether it's this support level, whether I want to draw a trend line like this, and maybe I want to pick it up somewhere down there. You know, and again, I'm just drawing that quickly. But the point is, you always have to evaluate and say, fundamentally, what got us here? Technically, I have a support level. Is that good enough, given the fundamentals, to say, I really like it? I think it's a good value to pick up the pound down here. And if so, where do I think it's going? Do I think it's going back up and it's going to go 11 pennies? Great. I can risk 3, 4, 5 pennies to make 11 pennies. Or do I believe it's going to go 11 pips and risk 6 or 7 or 8 pips to make 11 pips? So again, we can all, short-term, long-term traders can all get into things for the same reasons. They'll have different time frames and horizons for the trade. They'll have different risk-reward for the trade. But the point is, we always have to evaluate and reevaluate and reevaluate and reevaluate and say, is this the level that I'm looking for? Is this the deal that I'm looking for? So that's how fundamental analysis comes in and really starts to kind of tell us what's going on. If you looked at this today on a 5-minute chart and you said, oh, wow, I like it down here at this area for whatever reason, maybe it was a moving average, maybe it was a Fibonacci, you have to take that out and say, wait a minute, there's something going on. Until I understand what Ben Bernanke and the FOMC did in their statement, do I want to just step in here and buy like I normally would in a kind of a slower time, maybe earlier today when there wasn't much going on, or am I okay just stepping in here because I like it because it's my level? Probably not. You want to readjust and reevaluate and say, wait a minute, this is big. I mean, the dollar is really, really strengthening against everything. I got to be really careful if I'm going to step in and buy it here. Obviously, the sellers are in charge. We had a big move down. We had a small retracement, another big move down. So if I'm buying it, I'm buying it for very specific reasons, very specific locations for a very short period of time, because obviously buying it for a long period of time was wrong based on the fundamentals that were driving the dollar to get stronger against every single currency. Here it is against the euro. If we look at it on a 5-minute chart, here it is basically against the that's the Aussie. So the Aussie weakened significantly. Let's look at the New Zealand dollar on a 5-minute chart. The New Zealand weakened significantly, and then obviously the U.S. is going to strengthen against the Canadian. So there it is. And let's see, obviously against the Swiss franc, it looks like the U.S. dollar strengthened as well. So fundamentally, we have to understand things on these very, very busy days before we just go ahead and trade. Very different day today than yesterday if we look at the pound. Yesterday in the pound, I'll go out to a 15-minute chart. So look at the pound's range yesterday. The lowest point we hit yesterday was 56.50. The highest point was 57.50, 100 pips. Today, the highest point was 57.50, and the lowest point was 54, let's just say 50. So 100 pips yesterday, 300 pips today. Very, very different day, very different way to attack it. Maybe not so much early on, but definitely after the announcement came out, it was definitely a analyzing of where do I want to get in, why do I want to get in, do I want to step in front of this, do I understand what's driving it? So that's very important. There are announcements and speakers coming out every single day, multiple times per day. You've got to be on the lookout. You've got to be aware, and there's no way that we can be aware of everything. There are a lot of surprises. That's what I mean. Do not get married to anything. Do not get egotistical. Do not get emotional. Book your profits if you have a good trade. On to the next opportunity. The good thing is there's tons of opportunity, so you want to make sure that you are live to trade for future opportunities. Don't blow up your account by doing something stupid and saying, I'm right, they're wrong. I don't believe what they just said. I don't understand it. I'm going to stick with this. It's at my level. Levels don't matter when people are speaking, and fundamentally things are changing and devaluating and getting new valuations basically based on what interest rate policy from one country to the other is doing. So you've got to keep that in mind. It's very, very, very important these days. It's not the easiest trading. There's no doubt about it. Just don't get married to anything. Couple questions and we'll wrap up here. Can you tell me the best Eastern Standard Time frame to trade? So that's a perfect personal question. I don't know who's asking this. I encourage you to email me and follow up because I don't know you and your situation or anything like that when you're available to trade. So please email me, fill me in a little bit more data. I'll give you my email in just a moment, and then I can answer that a little bit better. So again, you have to say, what am I available to do? Can I work all day if I'm overseas and then stay up all night because the American session is trading? That can be very hard to stay up 24 hours. So you have to obviously do what's responsible for you. I find that technical analysis don't work as well on currency. Technical analysis is not really reliable. Do you also find that? Absolutely not. I'm huge into technical analysis, but again, as I'm telling you, I believe that you have to have a fundamental, view of what's going on, a fundamental opinion, so that you can kind of tweak your technical analysis to what the trend is of the day, where the movement is going, things like that. So absolutely technical analysis rules, especially if you're day trading and intraday trading and short-term trading. If you're doing fundamentals and longer-term stuff, that's different. But if you're a shorter-term trader, you have to use technical analysis. That's something I preach to all of my clients, and I don't let them trade on their own until they've surpassed a certain area and graduated, basically, to prove to me that they can be very safe trading technically and being able to explain to me a trading plan technically. I do believe that if you aren't a strong technical trader, I do believe that you will have trouble out there trading off of just fundamentals or trading off of just kind of guessing for the most part. So good questions, guys. Very, very good questions. Let me wrap up here the PowerPoint. All right. So again, why do I like to use technical analysis? So here's the answer to that question. Do the math. Technical analysis proves that you're thinking out risk to reward when using the charts. Divide your trade risk into your account risk to find out how many contracts you're doing. So you have a trading plan based on the charts to say, here's where and why I'm getting in, here's where and why I'm getting out for a loss, here's where and why I'm getting out for an exit. Now I can manage my trade from beginning to end. So you divide your trade risk into your account risk, giving you how many contracts, whether it's option contracts, whether it's shares of stock, whether it's foreign currencies, whether it's futures, whatever it is, it all works the same. Like I said, it works for option contracts here as well. So review, fundamental analysis is huge. Technical analysis, understand which way the money's flowing, whether it's long-term or short-term, depending on what type of trader you are. Understand where they're buying, which is support. Understanding where they're selling, which is resistance. See if there's intermarket relationships moving. Gold, oil, gold to the Aussie dollar, oil to the Canadian dollar, US dollar to the equity markets. These are moving. These are happening all the time, in and out, and they provide us with great trading edges. So you're always looking for an edge, and technical analysis can help you with that edge when you combine trend and support and resistance. Trading psychology. Who are you? So that person that says, what's the best time to trade? Depends on you. I can't do that unless I know who you are, where you're at, kind of a little bit more about you. That's a fiduciary responsibility to be able to say, okay, that's not just a blanket statement. This fits that person and their lifestyle and their risk tolerance and their time and things like that. So your situation. And then also those definitions today, account risk and trade risk. Ongoing education, we meet every 2 weeks at 9:30 p.m. Eastern, so October 5th. Same thing, we'll talk about fundamentals. We'll talk about technicals, the trend, support, and resistance review, intermarket relationship review. I haven't decided on a topic. You're going to get feedback in a few minutes as far as providing me with feedback, also providing Interbank FX with topics. Please fill that out. It's very, very important. Education recordings. This does go on the YouTube page, so you can find it. I comment every day on the Daily Forex Trading Edge, which is the same as basically my blog down here, Finance Banter. We also have the videos on YouTube, as I mentioned. We also have that Interbank Connect, that kind of social thing, the social page that they have. I'm on there kind of here and there, but I think that you can get a better handle of what I'm seeing, what I'm looking at from the Daily Forex Trading Edge and my blog for the most part there. So again, if you have some questions on your specific situation, I'm happy to help you out. This is my email. Please follow up with me, and you guys can get a better review of what I think you can handle. So that's a better way to do it. We can kind of trade some emails. I can find out a little bit more about your specific situation and give you some more specific guidance to you. Remember, it was about your game plan, so you have to be able to help identify that. If you want some help, I'd be happy to do that with some emails. Very, very easy to do. Thank you very much. Have a great, great evening. Please follow up with any questions. Please fill out that feedback form at the end of this webinar, and I'll look forward to seeing you every day on the blog and the Daily Forex Trading Edge, as well as in 2 weeks on the next webinar. Thank you very much.